Why is 2026 being discussed? What does history tell us? 2026. Recently, many economists and analysts have started mentioning this year more frequently. But why? Is a crisis really approaching? Or are we simply moving through a recurring historical cycle? Let's clarify something from the start. This is not a prophecy. This is not investment advice. This video is not making predictions. It simply examines economic patterns that have appeared repeatedly throughout history. And here's what's interesting. Major crises often emerge during periods when people feel the most comfortable. Section 1. Do crises really happen overnight? In the United States, the stock market had been rising for years. Everyone was making money. Credit was easily accessible. Newspapers were optimistic. Economists were reassuring. Then what happened? We all know. But that collapse did not happen overnight. Years of accumulated debt, speculation, and overconfidence laid the groundwork. A similar story unfolded in 2007. The housing market was considered safe. Complex financial products were presented as tools for risk distribution. The system appeared modern, regulated, and solid, until trust disappeared. This gives us our first important lesson. Crises appear sudden, but their foundations are built over many years. Section 2. How does the modern monetary system work? Today's monetary system is credit-based. When a bank issues a loan, new money is effectively created. It exists digitally on balance sheets. That means a large portion of the money supply is directly tied to debt. This may sound dangerous, but the system was designed this way. Debt enables investment. Production increases. The economy grows. Debt itself is not the problem. The real question is this: what happens when debt continues to grow, but economic growth slows down? What happens when interest burdens increase? Section 3. Interest rate shifts in history. Financial history shows a recurring pattern, a long period of low interest rates, followed by a necessary rate increase. These transition periods are often challenging. It happened in the 1970s. It happened in the mid-2000s. When interest rates rise, loans become more expensive. Investment declines. Corporate financing becomes more difficult. Real estate markets become sensitive. Today, the global economy is emerging from a prolonged low interest rate era. This alone does not mean a crisis is coming, but historically such transitions have often been demanding. Section 4. The core issue: trust. Money has no intrinsic value. It is not gold. It is not silver. Its value is based on trust. Trust in the government. Trust in the central bank. Trust in the economy's ability to repay. The hyperinflation in Germany in 1923 was not merely about money printing. It was a collapse of trust. In 2008, banks stopped trusting each other. The system froze. In the modern financial system, trust is invisible, but it is the strongest foundation. Section 5. So why 2026? Some analyses point to economic cycles, 8-10-year business cycles, maturity structures of major government bonds, corporate refinancing periods, political election cycles. Economies do not move in straight lines. They move in waves. Sometimes these waves overlap. Tensions build. This does not mean something will definitely happen, but sensitivity may increase. Section 6. Is today different from the past? Yes. Banks are more tightly regulated. Central banks have more tools. Transparency has increased. But at the same time, the system is more complex, more interconnected, more global. Complexity can create stability, but it can also increase dependency. Section 7. The real lesson. History does not tell us that crises are inevitable. It tells us this: stability rests on several foundations: balanced debt, sustainable growth, strong institutions, trust. When these foundations are pressured simultaneously, the system becomes more sensitive, not necessarily collapse, but increased fragility. Conclusion. Some experts mention 2026 not because they possess secret knowledge, but because they recognize that historically, difficult periods often emerge under similar conditions. History does not repeat itself exactly, but it produces patterns. This video is not meant to create fear, it is meant to reveal connections. Financial systems are resilient, but they are not invincible. The better we understand their structure, the more calmly we can interpret developments. The goal is not speculation, it is understanding.